Oh, yeah. Getting ready. Oh, yeah. Let's do an oh, yeah. Getting ready to go live. I think we're just about ready, waiting for a few people to show up. The end of the pandemic, sectors to look at. We've got a bunch of things to talk about. I love cross currents, makes it more interesting. Thank you for joining me. I'm Mitch Goldberg. If it's 4:30, you know it's time for Be the Boss of Your Money. It's a show, a live stream. It's about taking control of your financials, of your personal finance. We're going to talk about the stock market. We're going to talk about investing, the economy. We're going to talk about a couple of things. Tomorrow, I want to get into covering companies who have women as CEOs. So I'm going to have to put a little bit of a thought into that. But there's a few big companies today that are doing quite well who have women as CEOs. So it's pretty exciting. Anyway, let's get into it today. We're going to talk about what happened, what's going on. It's all about interest rates. We're back on track, back to normal. The stocks that should have been toasted, crushed, mashed up have been mashed up. The stocks that should be working are working, and we're gonna get into that. So here's a quick intro, and let's have fun. If you have any questions, hit me up in the comments. All right. Thank you for joining me. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. It's a live stream show about taking control of your money. If you have any questions about the subject matter that we're talking about or some other financial matter, investing, personal finance, planning, what have you, please hit me up in the comments. I love hearing from you. And while you're watching, if you'd like to also follow me on another social media platform, I'm on Instagram, LinkedIn, Facebook, YouTube. And yesterday, I've been on Twitter for years. I used to be a Twitter bug, no longer. But yesterday was the first time that I ever live streamed to Twitter. And I'm live streaming to Twitter right now as well, even though you don't see it in the social logos over here. I'm going to have to update this screen, this slide, so that is reflected. So we had a pretty good day today. I mean, the fact that stocks held up, more stocks up than down after the super impressive rally we just had, I think it's good. Really, what it was a recovery. Stocks are still not back to where they were a few weeks ago, but the market's tanked, starting with a 905-point down day in the Dow the day after Thanksgiving. Without getting into all the history, we've had some crazy volatile days. It kind of reminds us of early 2020, when the pandemic was just getting started and the World Health Organization declared a global pandemic. We had two things happen. First, we had the Federal Reserve saying, we're going to get a little tighter, a little quicker with monetary policy. I'll explain that in a moment. And then we had Omicron. And it was just too much for markets to handle. And what I've been saying is the markets were ripe for a pullback. We've been up so far, so much, and on such hype kind of stocks. They're just crazy valuations like we haven't seen since like the year 2000, 1999, 2000. We were due for a correction. Maybe if Omicron was discovered, and maybe that wouldn't have thrown us into a tailspin. Maybe if just the Fed said they're going to taper sooner, and their bond buying program, which is, stimulus to the economy, if they said they would do that, they said they'll do it sooner. If it was just those two things on their own, exclusive, one or the other, I don't think things would have been so volatile. But the two of them together was just too much to bear for the stock market that was already teetering on the edge of a, let's call it, profit-taking time. So here we are. The major averages have mostly recovered. We're, we're literally walking distance from all-time highs in the major averages. The stocks that got absolutely crushed deserve to, and this is good. This little turbulence we had in the last week and a half, it it helped wring out excesses so that we could get back to focusing on what is viable, companies that are healthy, companies that should be around for a long time, companies are showing growth. Uh, Either cyclical growth, which is because the economy is strong, or growth, even if the economy gets weak, companies that still have growth. But the companies that were just showing growth because of the pandemic, work from home, stay at home stocks, they got crushed, deservedly so. The question after that was, does the crushing of these stocks spread to the rest of the stock market? The answer is no. I mean, no one has a crystal ball, but right now I'm comfortable saying no because I'm going by what I'm seeing at the moment and reading the tea leaves. And then I do my best to move forward with an investing point of view. Uh, so, in the meantime, airline stocks got hit. They're recovering. Boeing recovering. GE got hit recovering. GE is going to split up into three different companies. Cash flow is improved. CEO is getting a lot of kudos for doing a great job. CEO Culp, that's his last name. Boeing is finally has approval to sell their Max series jets, the replacement for the 7 series. Hold on. Who dare calls me while I do my live stream? It's my fault. I didn't hit the privacy button. Voicemail will pick it up, and I could tell by the number. It's no one I know. It's definitely a cold, one of those spammy cold calls, probably for a warranty for a car that I haven't owned in at least 10 years. Extended warranty. I know you get these calls all the time. Okay. So now the question is getting back to normal stuff. I want to take you through a quick tour of the market today and give you a couple of quick things to focus on. Okay. All right. When the market was taking its beating the last couple of days, how did you react to it? Did you do nothing? Because if you did nothing, that's okay. I did nothing. Uh, I don't let I don't let big gyrations in the just make sure the mic is picking me up appropriately or properly. I don't let giant um, moves in the market dictate what I'm going to do. I control what I can control. Clients, how they're invested, asset allocation models, uh, stop loss orders, buy limit orders. You know, we're in it for the long term anyway. So that's what I could control. Our clients' accounts titled properly, joint with tenants, joint with rights of survivorship, joint tenants in common. Make sure your updates are correct. Make sure you updated your beneficiary designations. Uh, I look to see if a client's term life policy is about to come to the end of its term well in advance, actually, and see and reassess the need. For example, if the client needs to continue insurance, or if they don't, for example, these are the things that a financial advisor does. It's the day to day. It's the day to day stuff. Kind of boring, not necessarily exciting. The stock market's exciting. Following the latest Fed policy move, to me anyway, is exciting. Is the Fed going to taper? Is it not going to taper? I enjoy hearing about this stuff. I enjoy hearing about and reading what's up with the International Monetary Fund. I like reading up about elements like lithium, commodities like oil and lumber, and putting it together and making my own forecasts and choosing investments based on that. It's a joy, and not everybody I do that for. Some people are just in a mix of an asset allocation modeled portfolio using index funds, and that's fine too. By the way, you cannot invest directly into an index. You can invest into an index fund that tracks or mimics an index. So, what else do we have to look at? The Fed. Okay, the big things are this. All right, Friday, December 10th. You have the CPI number coming out. Okay, this is the next CPI number. All right. So the consumer price index numbers are coming out on Friday, and we expect that number to be pretty high. If it comes in higher than expected, then there's no question the Fed's going to accelerate their taper. And then the next big event is next week. The Fed meets the FOMC, Federal Open Market Committee. So I enjoy this stuff. The first time I ever learned about the FOMC and what it stands for, I was in college. I was a finance major at State University of New York at Albany in the business school, which still is a very respected business school. And these are the things that we used to learn about. So I'm like, 21 years old, learning about FOMC meetings and policy. It was pretty cool to get into this stuff back then, and I like it now. Yeah, I don't know if anyone else thought it was cool, but I did. So we have the 2-day FOMC meeting. It ends next Wednesday, so around 2:15, 2:30. We're going to find out what the Fed wants to do with its taper and maybe talk about interest rates. The expectation now is that a few more than half of forecasters are thinking that the Fed should will probably raise interest rates 3 times in 2022, starting in May. Some people are saying no, the Fed won't raise until June, and they'll only raise rates 2 times in 2022. 2 or 3 times is not really the problem. It's or a big deal. It's the rate of hikes, and maybe 4 rate hikes in 2023. If they get to the rate hikes sooner, like let's say March or April of next year, that could be a problem. But I don't think investors want to see the Fed uh, signal that they're going to accelerate their reduction of fiscal support of monetary support. I don't think investors want to see a reduction in monetary support from the Fed any sooner than what they're telegraphing now. If they do, then we do get another leg down. All right, so those are the big broad strokes. There is good inflation. Not all inflation is bad. Companies actually make more money in inflationary times as long as they could pass price increases to consumers. At some point, consumers say, "Uncle, they've had enough," and they just stop buying stuff. Right? It's been reported. It's true. Most of the raise that people have gotten in 2021 has been eaten up by inflation anyway. But inflation is expected to moderate next year as supply chain disruptions are finally cleared up. So I'm giving you the broad strokes. This is like international sign language for the international or for the broad strokes. Okay, so that's what we're looking at. Probably like my green shirt. It's my lucky shirt. Happy St. Patrick's Day a little early this year. I can't wait till St. Patrick's Day. That's because it starts getting uh, it starts staying light out longer. We turn the clocks ahead by then. So I'm looking forward to it. I can't stand when it's dark outside at 4:30. Although we've had a pretty warm December so far in the Northeast, so I'm not can't really complain. All right, so let's take a quick walk through Wall Street today. And while you're watching this, if you could give it a thumbs up or a heart or a celebrate reaction, depending on what platform you're watching me on right now. And if you want to ask me a question or leave me some words of wisdom or words of encouragement in the comments, I always appreciate that. Let's get rid of the social media icons. I'll pop myself up in the corner. All right, here we're in business. So you see this UAL. I'm going to make this bigger so you can see this. All right, that's better. All right, UAL up 4%. AOL, ABB, Boeing. Boeing was like 195, 192. So now it's 211. GE was 105, 106 recently, 116 recently. So Boeing, GE has a ways to go. Lockheed Martin, things are getting strained with Russia. Maybe, as a defensive mover, you should buy a defense company, right? Lockheed Martin. But I want to show you some of the interesting things out there. Let's look at the meme stocks. And I actually have a list of meme stocks, memers. Let's look at the after hours trading first, okay? Because GameStop is down almost $10 a share, down about 5%. Came out with earnings, losses are just growing. They do have cash on the balance sheet, but you can only lose money for so long until you use up the cash in your balance sheet. And then you have to go by the good graces of investors to say, we're going to keep losing money. You know, they're trying to convert to an all digital company, but they've got thousands and thousands of stores, and their inventory went up from like $800 million worth of inventory to 1.1 or $1.2 billion. So they had a big increase in inventory, expecting that they're going to sell a lot more stuff this holiday season. Um, I would think if you have more inventory, you should do better because retail sales are so strong. But you know, GameStop sells a digital product, and I just don't know if people go to stores to buy a digital product. Like, why would you? Why would you go out? Why would you go out of your way to buy a paper copy of a newspaper when you could just buy it online, right on your phone or your iPad, what have you? Okay, so that's what I'm thinking. But let's see how they did today. That's after hours. But overall, AMC, look, you know, these stocks are down an awful lot from their highs. Clover, Wendy's, you know, is a legitimately real company. They did get caught up in the meme stocks and Hood. Hood, I don't know. I'm not saying Hood is. I don't like Hood. I have a problem with Robinhood. I've talked about it here a million times. I think if you have a relationship with Robinhood, I believe that you are actually in an abusive relationship and you just don't realize it because of the way Robinhood makes money and because of the way they try to hype you to trade more stocks. There's going to be a lot of young people, especially males, with gambling problems coming out of this pandemic because, in part, because of Robinhood. They use social engineering techniques to get you to come back to the app and trade more, just like Facebook or Instagram, right? Um, you could blame the user, or you could partially blame the platform. I'm partially blaming, to a large extent, the platform of Robinhood. Okay, so let's go on, and I want to show you the crypto stocks. I have a list of crypto stocks, and this is interesting because you're thinking, what? There's a list of crypto stocks? Okay, they're all up today. What I mean is companies that have a nice size focus on crypto. So Robinhood is obviously a place that people buy and sell crypto. It's probably like the second place to go to after Coinbase. Coinbase was 429. Now it's 287. Square, Micro Strategy, which was $1,300. Now it's cut in half. Visa, 252, down to 208. Visa is a legitimate company. I'm not knocking them. They are introducing a platform to either teach you or help you trade or buy or use or do business with Bitcoin. I have to read more about it. MicroStrategy is just, they're betting everything on Bitcoin. Uh, Coin and Hood are basically like digital brokers of digital assets, and you know that's it. All right. So let's take a look at a couple of other areas that I think are super interesting. Okay. And let's take a look at the Corona list. I didn't put Stitch Fix here. Okay. But, you know, this, some of these stocks did okay. Disney has been a Corona stock because of Disney Plus, digital Disney. But they're getting some lift now because we're getting back to business. All right, we're getting back to life and going out. Zoom was up a little, DoorDash up a little, Teladoc. Okay, so I'm glad they're up a little bit. DocuSign was up 15, good for them. Roku is up a lot today, down from 490 still, but they got a deal today that they're going to continue to be able to offer YouTube and YouTube Live on Roku. So it helped them out for today, but still, down by almost half from their all-time high. But I want to look at Stitch Fix. Every day there's a disaster of the day. New 52-week low on Stitch Fix. Stock down 24%, down from 113. The reason it was up to 113. Okay, let's look at the year-to-date chart. This tells you a lot. Okay, the reason it was up so much was basically they got swept up in the short covering rally, the meme stocks. If I do recall, the management of the company were tooting their own horn about how great they are because the stock was up, and it's just a short covering rally, and back down to uh, $19 from 100 over 100. This just got crushed. I mean, can you imagine you were the person who paid $120 or $115 for the stock, and now it's 19, and you're like, oh, they're going to come right back one day. I don't see it. We're not just shopping online anymore. We're going back to stores. Okay, so let's talk about that. End of the pandemic. Where do I see money going to, and where could people take a shot? I think it's where people are still underinvested. Domestic sectors. We're still going into that rotation from technology, work from home, stay at home, into cyclical sectors, energy, industrials, financials. I see money continuing to go into those spaces, and I wouldn't hesitate to get exposure. You could use exchange traded funds. I'll show you the ETFs you could look at for all the different sectors. International, international has been dead money for so long. You never even hear anybody talk about international, but international is an important asset class. I know for my clients, we favor a small allocation to international. So we favor a small allocation into international investing. It's been a drag on portfolios. What can I tell you? But that's the point of diversification. While some asset classes zig, some zag, right? And when they have their day, great, because the other asset classes that are doing really well now could be the ones that go down. And I'm going to want different investments to moderate. Eventually, they all go up. Okay, eventually, we expect all of our asset classes in stocks to go up. International, small cap, mid cap, and large cap, to name the four basics. But if they go up over, let's say, the next 15 years, they'll do it at different times. So some zig, some zag, and that helps moderate the volatility of your portfolio. Volatility is important. It's not the end all and be all. I think volatility is important because if your portfolio is too volatile, too much up, too much down, it might not be too much for you, but for a lot of investors, they might not be able to, take the pain anymore. They might want to sell out. They might not be able to stick with their long-term investment plan if it's too volatile, if the ups and downs are too volatile. Okay. Now, diversification is a strategy that we use to help reduce risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. But it helps moderate the downside. It helps moderate the upside, keeps your portfolio in a smoother plane. So if your portfolio goes down because the market went down, the way we expect it to work is that your portfolio will go down less than the market in a bear market, and it'll recover faster than the market when the market recovers. But it won't go as high as the overall market because it'll have asset classes like international for the last 11, 12 years that could underperform. But that's what diversification is, and that's what being a global investor is. So just wanted to make sure we covered that. So I like international, and I think the world order says that more and more people around the world are doing better. They're eating more meat. They're driving cars. It's almost like we forgot about the international story. The international story was always like people are going around the world are going to get air conditioning. They're going to get indoor plumbing. They're going to get electricity. They're going to have toaster ovens and refrigerators and cars and computers and mobile phones. And that is all happening. And it means that other countries in the world where the populations are also younger and have more time to acquire their home country stocks, that could be a very bullish thing for international stocks. So don't abandon international. I've done entire live stream shows on investing international, so I wouldn't abandon it. And that's where I think money goes. So if you are not invested in international, or you're still hanging on to these work from home, stay at home stocks that are down 50, 60, 70% or more, you might want to consider making a switch into something different. It's hard to sell at a loss for a lot of people. I learned from somebody when I started in the industry in like 1990. An older guy said to me, when I say older guy, a guy who is my age that I am now, said to me as a 22-year-old, said, the number one reason that people sell a stock is to break even. Okay. And the other thing that I've learned is, people sell their winners, but they hold on to their losers because they don't want to sell at a loss. They want to wait till they break even. But think of it this way: if your portfolio is $100,000, and some of you, your portfolio could be a couple million, some of you could be 10,000, 5,000. I'm using 100,000 as a round figure. If your portfolio is 100,000 and now it's down to 60,000, or let's say 60,000 because you overloaded on meme stocks, you overloaded on Stitch Fix and Zoom and DoorDash, and you're like all messed up in the head, like how could you lose so much money? Let's say your portfolio is down to 40,000. Well, if you had to start today with a $40,000 portfolio, what would you do with it? You'd probably learn your lesson, go into more stable, dependable companies. You might want to consider some that pay dividends. You might want to consider some companies that are cyclical in nature, some that are growth in nature, some companies with track records that span more than like a couple of years old. And you have that opportunity now. So don't look at like I'm selling, just look at at a loss for a stock or a group of stocks. Look at it like this: it's my portfolio. It's the same $40,000 or $50,000 or $60,000. It's the same portfolio. It's the same amount. I've just changed the composition of the portfolio. And when you get like cold as ice about it and really give it just a totally unattached, unemotional view, you will be so much better off, and you'll be able to jettison a lot of the stocks that will probably, in my opinion, never come back. I mean, some like Stitch Fix, is it going to go from 19 to 120? The stock would have to go up 600%. If it went up 600% in 20 years, it's actually not a terrible return. Okay. But people think like, oh, they're going to go right back up. No, unless you have another complete shutdown globally, they don't go right back up. And we're not going into that. So that's my story. I'm sticking to it, and I will see you tomorrow. Thank you for hanging out with me for a little while, and I hope you have a good rest of the evening. Bye.